Okay, terrific. Well, we have an hour together this afternoon to talk about the wily and wonderful world of risk. This is Risk Management 101. Make sure everybody's in the right place. And I'm Leslie. And some of you all, I recognize faces from yesterday, or from this morning, I should say. So thanks for those of you who were in the sales conversation. So how is everybody? Good? Are we enjoying the day? Enjoying the content? Cool. All right. So hopefully we're going to end strong, ladies and gentlemen. We're going to end strong with risk. I really want this to be a participatory and interactive session. A, because I think risk is that cool. And B, because it's 4:20 in the afternoon. And so I need you guys with me in participating so we stay focused and energized. So first, I'm going to go through what we're going to talk about today. Then I want to pulse check with you all to make sure that this meets with your expectations of what you would like to get out of our time this afternoon, because risk is a big old topic. It's one of my favorite things to talk about. For those of you who've heard my collections shtick, which I will be giving again tomorrow, and I did last year at Lend for America, you know that, again, talking about risk and talking about relationship, these are the things I love to talk about when it comes to the work of community development finance. So what we're going to do today is I'm going to give you, just tell you a little bit about myself, talk about what the key concept is for us today, and then I'm going to do a deep dive into this concept of risk. First, I'm going to define risk for you all, not only specifically what do we mean when we say risk, but I'm also going to talk about the categories of risk that we're referring to when we talk about risk management and microfinance. I'm going to dive deeply into two of those areas of risk, and then I'm going to spend some time doing resource and reflection, but I'm going to give you also some suggestions and thoughts around how to monitor risk within your programs. So that's what we're going to do today. Does that sound good? Excellent. Okay, super. Do me a quick favor and everybody stand up and turn to the person in front of you, if that's possible. And if you're in the first row, turn around. Figure it out. And just say hello to somebody you don't know. Excellent. Okay. And have a seat. Okay, if you can hear my voice, clap once. If you can hear my voice, clap twice. If you can hear my voice, clap 3 times. If you can hear my voice, say Yahoo. Okay, awesome. Have a seat. Okay, just fair warning, I'm going to do that to you a couple times. We're going to keep the blood pumping, okay, during this hour together. So who am I and why in the heck am I here? So my name is Leslie Hoffman, and I have a business called LEH Consulting Group. And this, as some of you all heard earlier this morning, I celebrated my 6-month anniversary of LEH Consulting Group last week. When I was here last year, I was here as a microfinance practitioner. I was lucky to spend 8 fantastic years in an organization called Acción, New Mexico, Arizona, Colorado. And then after helping people start businesses for about 8 years, I decided to do it myself. And so I'm happy to say I'm here now today as a macro entrepreneur myself. I'll spend a little bit of time teaching at the college level as well, since you and I saw each other last time, for those of you who I got to meet last year. But the reason I'm here to talk about risk today is it goes back to the work that I did over those 8 years. And a lot of the work that I did over those 8 years was helping to try and manage the risk of our organization at Acción. By the time I exited from the risk management role, we had a micro loan fund portfolio of about $6.2 million. And so it obviously gave me a real opportunity to learn a lot about risk, both in the hard ways as well as in the really positive ways. So that's why I'm here. And what I'd like to do with our time today is give you as much as I can about what I learned, both the good, the bad, the ugly, everything in between around risk management. And the thing to know about me is, again, some of you heard earlier today, is the way I started my career was as a print journalist. And so what I love are words. I love words. I love communicating, obviously. I'm a talker. And part of what I love is the definition around words. And so I decided to go into Merriam-Webster to look up what do we mean by risk. And this is what they said: a situation involving exposure to danger. I will say I have an alternative definition of risk, as it relates to the work we do in microfinance. And it comes from a circumstance that I had several years ago. This was earlier in my risk management career in microfinance. And we had some portfolio challenges in the program that I was working on. And so we had to figure out how to remediate those challenges. And Joyce and her colleagues actually at Field and the Aspen Institute, where I also now do some work, actually wrote a white paper that I'm going to give you the side of later about how we remediated all of that. And so we brought in this guy who was a third-party examiner for community banks. And so his work was doing safety and soundness reviews for community bank portfolios. And he was going to help us do some of that same work within our portfolio. So I sat down to talk to him after he had reviewed our portfolio for the first time. And he said it was certainly different, what he had seen, but that he was in. He was willing to come and help us. And I will say, his name's Scott Edwards. I learned a huge amount about risk from him. And I will never forget what he said as we closed that first meeting. After we had talked about our portfolio, we had talked about concentrations, we talked about a lot of things, and we'll talk about those today. He turned and looked at me, and he kind of smiled, and he said, "You guys are crazy." So that is my alternative definition of risk. A situation involving exposure to crazy, which is a little bit of what we do. And in my opinion, that is some of the secret sauce of what we do in microfinance. Because microfinance, in some regards, is a situation involving exposure to crazy. Because we put a lot of very interesting concepts together that, as you heard from Mark Pinsky earlier today, was absolutely thought of as totally crazy about 20 years ago. What's interesting for me and Mark and others who have been in the field for a while now is that for you all, this doesn't sound crazy. And that for us is success. That the idea of bringing together community development and finance in a way that creates access, open and equal access, and alternative definitions to very traditional terms is fantastic, but at one time was thought of as crazy. So let me ask you this. I'm curious to hear from you all's perspective, why is the concept of risk important to think about from a business perspective in running microfinance programs? What's important about this idea of risk? Why are we talking about this today? Does anybody want to take a shot? Answer to that question? What is the business case for talking about risk in microfinance? Great. Okay, so could everybody hear her? Great. So she raises the sustainability issue. Absolutely. Risk and sustainability are very connected. What else? Why else do we need to think about risk?
I said if your loan fund is too risky, it hinders the amount of people you can then serve.
Very nice. You guys, right out of the gate, so smart. You guys have hit the two things I wanted to hit, and that is there are internal and external reasons that we talk about risk. Internally, within the operations of our programs, we need to understand what kind of risk we're taking so that we can ensure we're building programs that are sustainable from an operations perspective. We also need to understand the kind of risk that we're taking because it otherwise will threaten our ability to serve people. So the more we understand what risk looks like, what kind of risk we're comfortable with, and how to measure and monitor that risk on an ongoing basis, then the more effective we can be in actually meeting our needs, meeting the needs of our customers and consumers. Okay? So that's why we're in this conversation. Now, what I can tell you is that banks have some very sophisticated approaches to this conversation. And in fact, we could spend the equivalent of a whole college semester actually on this idea of risk. This is a whole academic school of thought. And so I just want to expose you and give you a sense, and some of you may, if you are taking banking classes in business school, may have already heard of some of these terms. But this gives you a sense of, in the traditional financial institutions world, there is an entire discipline around risk management. And so you'll hear terms like this, the KMV model, option theoretic model, credit metrics model. For KMV, this is a model that basically spits out an expected default frequency It's essentially a probability of default based on what's in a portfolio at any given time. Then you've got the option theoretic model, and that actually provides a quantitative expression of the possibility of loan default losses. So it can quantify within a portfolio what potential losses you may experience. And then the credit metrics model, this is a commercially available product, actually. You can go out and buy this. It's commercially branded. That quantifies risk across a broad range of instruments. So a variety of things, fixed income instruments, commercial contracts. You can actually buy the credit metrics model to understand, get a specific quantitative expression of the risk within that particular instrument. So there is a whole lot of math that goes into those methodologies, but I just want you all to get a sense that, again, there is a whole system, there's a whole academic study around risk management. So that's the good news. There's a lot of information out there. But for you all today, I want you to be able to walk out of this session with some basic tools in your toolkit for you all to start to think about this topic. Because again, this is an enormous topic. And I want you all to be excited about risk and excited about the prospect of managing it. Because my definition of math that goes into community development finance is really pretty basic. And the math looks like this. We take risk, and we add to it a very, very important second item, which I talked about this morning, to be able to get what it is we all want and why we're all here, this idea of impact. So this is the math that you all get to do as microfinance practitioners. To take into account the risk that you're taking from a practitioner perspective, add to it your relationship building process to be able to arrive at the kind of impact that you want to achieve. From a risk perspective, there are 4 critical areas of risk that I want y'all to keep in mind. We're going to go through these concepts, and then I'm actually going to have you guys do a little bit of individual work, okay? So this is going to be a clinic kind of experience. So these are our 4 areas of risk within organizations. And what I want to do is I want to check in on each of these areas of risk to see if anybody wants to take a stab at what we're talking about. Because I have a feeling you all probably already have a sense of each of these 4. You may not have used these words, but I bet you 10 to 1, because most of you, I think if I recall from this morning, are all working in programs right now, have experienced these 4 areas. And just a reminder, again, these PowerPoints are going to be available to you via the website, on the conference website. So credit risk. I find the most obvious area of risk that when I ask people to define risk, they typically skip right to. And it's the one that is probably the most tangible for us. It is the most tactile, so to speak, because it's the one that involves that daily work with our clients. So does somebody want to take a stab at what I mean by credit risk? Yes, sir. That's a part of it. Yep, absolutely. So people not paying their loans back, which is what this gentleman said, I think is a good indicator when you have taken on too much credit risk, right? Anybody else want to take a stab at credit risk? Understanding of, definition of credit risk? Yes, sir? Good question. So he just asked, is this individual or is this aggregate? It's both. So understanding your credit risk within an organization starts at what is the risk you're taking on a per person basis. And we're going to talk in a minute about, it's a great question, because the larger you get, the more you have to pay attention to that aggregate answer. That is to say, the kind of risk you're taking within the large portfolio. A lot of you from a volume perspective, as I was reading through your page descriptions, are still, you're at maybe 1 or 2 loans a semester, right? Is pretty much not if I'm on the right track for a lot of you guys in the room. Like, that's about your volume right now. So practically speaking, this is more of an individual conversation right now. But what I want you guys to start to think about, though, is the second piece of your question/answer, and that is, what those 2 and 3 and 4 and 5 people start to look like together as well. But credit risk is simply the amount of danger you're exposing yourself to in the credit decisions you're making. Credit being the decisions you're making to extend loans to individual borrowers. So your ability to ascertain whether they are both willing and able to repay your loans, and also taking a step back in those cases where you have enough people to look at from an aggregate basis to also understand that second word down there, concentration. That is to say, are there any concentrations of risk you are taking within your portfolio? What I'll liken this to is we've got a lot of TA folks in the room, if I recall, right? Raise your hand if you come from a program that does some form of technical assistance, coaching, consulting. Okay, that's what I thought. Fair number. So this is a similar piece of food for thought as the kind of coaching that you give to your clients around concentrations of their receivables in their business. And what typically do we say to our small business owners when you can see that a lot of their sales are tied up in maybe 1 or 2 really important clients? What do we typically say to them about that? What's the kind of feedback we might give? Yes, sir? Right, that they need to diversify. We are flagging for them a concentration of risk within their receivables. The same thing goes for you, actually, in your receivables, known as your loan fund. So you may have concentrations of risk geographically, startup versus existing businesses, et cetera. That's what we mean when we say concentration. Now, market risk. What do we mean by market risk? What might be some obvious categories of risk within markets? Ooh, good. Regulatory environment. That's a big one. That's a huge market risk. If there was a change in the regulatory environment, that would be a market risk for us to mitigate. Yes, sir? Good. Interest rates, business cycle, exactly. Mm-hmm. Good. So business cycle within the business, so more of a micro set of effects as well as the macro, right? And that's things like interest rates, largely, not just ours, but interest rates of other lenders. So macroeconomic environment. Yes, ma'am. That's exactly right. Demand. So target market considerations. Do the people we want to do this work with want to do it with us? Are they looking for these services? These are market risks. Operational risk. What do we think I might mean when I say operational risk within a microfinance program? Go for it. Yep. So did everybody hear what she just said? Staff member does something untoward, essentially, and creates an exposure to lawsuit. She's referring to anything related to your team. Team, infrastructure, that's an operation. Those are operational risks. What are risks you're taking by the way you operate your program? And then finally, liquidity risk. I will say Mark Pinsky said some really interesting things about liquidity risk. I don't know if you picked that up during his remarks today when he was talking about the kind of runway organizations can create for themselves with really good balance sheets. Do you guys remember that part of his remarks? Leverage, that right? He was talking about the degree to which you are leveraged or not, giving you choices. This is exactly what he was talking about, liquidity risk. So the way you are managing the balance sheet of your organization, even if it's a teeny little balance sheet right now, that is to say the degree to which you are financially healthy and or not indebted too much, as a program is what helps ensure that you have a sufficient amount of resources over the right amount of time. That's what we mean by sufficiency and duration in liquidity risk. So pretty basic stuff, guys. How are you making loan decisions? What's the environment that you're operating in? How are you putting together your program? And what does your financial health look like as an organization? So really strong core fundamental concepts that I want to encourage us, and we're going to dive more deeply into in a moment. Practically speaking, let me just let you know what the dynamic tension will be as you guys get into these concepts. And let me help you look a little farther down the road for your programs when you move from 2 loans a semester to 12 loans a semester. This is what you're going to start to experience, which I call the rub. And the rub is somewhere between, if we think about what we call the industry definition of organizations that have that U.S. Department of Treasury certification, community development, financial institutions, you experience the rub somewhere between here and here. What do you think I mean when I talk about the rub? The rub between community development, financial institution. Something to do with this image. Where do you think there might be some dynamic tension there? Yes, sir.
Trying to find a balance where you can use the fact that you have a relationship model to offset that the more risk you're putting yourself towards.
Nicely done. Nicely done. I will tell you, organizations large and small in the CDFI world right now are still trying to figure this out too. This rub is always there and will always be there. And I will tell you, the more you do in your programs, the more you're going to feel this rub right here. And that's a good thing, I would suggest to you. It's how you know you're getting closer to risk management. Because there is, in fact, an inherent dynamic tension in the work we do, on one hand, to be as relational as possible with our clients, and on the other hand, to be as rigorous, as transparent as possible. Because then we start to get into things like tracking data, right? That feels a little more down here, right? But we still really want to help that person that doesn't maybe fit within the box we just created around credit risk, right? That's the rub, guys. And that is, when you are in this place, you are in the center of risk management work. So what we want to do today is give you some tools to make some decisions about how you deal with the rub, all right? Now, from a credit risk perspective, we know that there are a variety of things that we can do. There are ways we can make decisions that help us manage our credit risk. And this is not an underwriting session, but I do want us to take a little bit of time right now to dive deeply for a moment into how we are making credit risk decisions. So what I'd like you guys to do is I'd like you to pair up, look around, find somebody who is not in the program you're from. So do that real quick. Somebody who, remember you just said hello to somebody, hopefully, who you didn't know. So that person. And I want you guys to take 2 minutes. This is going to be rapid fire. And I'd like you guys to compare, make a quick list of qualitative factors and quantitative factors you use to make lending decisions. If you do not make loans, and you only, is there anybody in the room right now who doesn't make loans at all, who only does TA in their program? Okay, then I want you guys to figure out if they're in the way you measure impact, okay, rather than the way you do clients, the way you measure impact. So I want you to do a quick list for me, lenders, of qualitative and quantitative factors you use to make a loan decision, okay? 2 minutes. So, curious, does anybody want to share if they found that they had a lot of common factors? Any pairs have a lot of common factors between their programs? Okay. We'll do you two, or were you guys like a 4? Okay, yeah, sweet. I'm gonna hand you the mic. Let me know what's in common.
So I think all of us are using references and kind of ask the third party, what do they think about this person, you know, during the same time as we approach this person. And also, I think all of these, the feeling of trust and just like when you're interviewing them, how do you feel about, you know, just are they really on track with what they're doing? And sometimes they will say, oh, I have this website. And actually afterwards we'll check whether they really have the website or not. And just, you know, it's not that we don't trust them, but it's just from these like simple questions and you verify whether what they're saying is actually what they're doing. These little like small behavioral things to determine qualitatively whether they're doing things. Yeah.
And did you guys have anything that was different?
We have a lot of partnerships with like local nonprofits, so we have a lot of like referrals in our program at least. So we would get referrals from like this organization called MICA, which handles like which is a food bank and things like that. So.
And so I'm assuming that referral is obviously a positive. It's part of what you use to sort of endorse somebody. If they've been referred by a trusted partner, it's a form of endorsement. Okay, good. So that's great. What you've just heard are example of quite a few qualitative factors, right? Which you can use a lot of when you are a smaller scale. The push starts to come as you get bigger. Trying to answer the question, for example, you gave the example of gut instinct. How do we document that? How do we make sure everybody's sort of using the same set of standards to do that? That becomes taking your risk management approach and scaling it a bit. Who had a lot of different? You have a lot of different and some quantitative? Somebody want to share? Sure. Yep.
Years in business. We kind of debated whether that was quantitative or qualitative, but I think getting to the reputation risk, or you know, the person's community reputation in the community. So things like a referral from a minister, person goes to church, or other people in the community vouching for the person, something like that, letters of reference, that kind of thing.
And that, you know, I think all very much goes to this foundational assessment of character as a part of your credit risk evaluation, which we'll talk about in just a second. And I think you've given examples really that are great and bridge both quantitative and qualitative, certainly. Yeah. So part of what I wanted this exercise to illustrate is when we typically talk about quantitative credit risk, you start to hear some similar themes across credit risk. Things like, what is your FICO score? What is your bankruptcy index score? As a side note, that's a newer product available out there. That's TransUnion's product, but each of the 3 credit bureaus have their own. That is a quantitative expression of the potential of bankruptcy risk. That is not a credit score. It's a different product. And then there are these other things that we're going to talk about in a second around capacity, loan to value, et cetera. You all have given some wonderful and great examples of both business characteristics as well as borrower characteristics. So these are all ways that we can understand and quantify as well as express qualitatively our credit risk. But we can already hear that within programs, there are a lot of different ways to slice and dice these terms. What I want to introduce you all to is a way to bring your factors together that can help you start to standardize the way you look at credit risk. And it's the 5 C's of credit. Some of you who've been in lending perhaps for a little while have heard of these. Let me ask, anybody familiar with the 5 C's and or ever heard of the 5 C's? I know Dan has. Okay, ooh, I'm so excited to share this with you guys. This is one of my favorite things when it comes as an underwriter, which is one of the things I did in my previous job. So the 5 C's for me really became the paint colors that I used as an underwriter to create the picture of risk for us as an organization to understand that we were taking in each borrower's case. So I would use as my ingredients those factors we just talked about. And then the picture I would paint would be a picture of 5 C's. The first, Dan just spoke to, and it's character, as well as our reference examples, right? We're trying to understand the person. Foundationally, what we are trying to understand in character is their willingness to pay us. When the cards are down, are they willing to pay us? It is the most important C. And we now have some really good specific factors we can use to either qualitative or quantitatively discern it, because we just talked about a few of them. The second most important C, I want to see if you guys can guess what the theory may be behind the second C. You don't have to guess the actual word. But you just saw a bunch of alphabet soup up on the previous screen. Let's think about credit risk. I want to make a decision about whether I should lend somebody money or not. Question number 1, would they be willing to pay me back? Question number 2, are they able to pay me back? That's exactly right. This, ladies and gentlemen, is the most important financial risk mitigant that you can focus on, that Rowan Matthew does a wonderful underwriting class on, that literally pretty much the entire class is how to underwrite capacity. So can they afford your loan? So when you get into conversations about things like debt to income ratio, which is what DTI stands for on the previous slide, or debt service coverage ratio, which is what DSCR stands for on the previous slide. If anybody's interested in getting into those conversations, I'm happy to do so after. But Rowan's got a great class on that. So, will they pay us back? Can they pay us back? Are they solvent enough to be able to engage in this relationship? Capital. And what are they bringing to the game? Do they have something that lets us know that they have skin in the game as well? If you are folks who are taking collateral, if you do secured lending. And then finally, this goes back to something we talked about before. Remember, we talked about market risk. What is the market risk in this particular loan? What are the conditions, both internal to the business as well as external to the environment in which they are operating, that we need to keep in mind? Okay, so that's it. It's the 5 C's. This is one of the coolest concepts I've ever been introduced to in lending. That really, if you follow these 5 C's, can give you a pretty substantially comprehensive look at the credit risk you're taking within your file. Alex. Yeah, great question. So capital is a broader concept. Collateral is referring specifically to assets that the borrower owns. We want free and clear, that they are willing to pledge toward the loan. Capital refers to the larger capital base that they have to be able to enter into this business. So do they have savings that they might throw in? Are they already borrowed? Have they already borrowed a lot? Are they leveraged already? But another word that we could supplant here is maybe what does their personal balance sheet look like, right? What does their net worth look like? How healthy are they today before they've even gotten the loan from a fundamental financial perspective? That's also related to this question, can they afford it? But this is a little bit more of a P&L conversation, and this is a balance sheet conversation. In other words, this is what's coming in and going out, and what do you own? Great question. Yes, sir. Yeah, absolutely. And that's what's fun about these 5, is that the wonderful world of credit risk is it's up to you to decide the cocktail that is these 5. And if you find that there is an entire C, for example, you want to skip, then it means you get to go to the other C's to figure out where are there ways we can mitigate our risk in other areas? Or is there something creative we can do, an alternative definition to one of those C's that we can document? So an example might be, certainly we know in the international case, the answer to that question is collective group lending, that the signatures of each of the group members actually serves as the collateral for folks who don't have any collateral. Another answer here in the United States is certainly unsecured lending, where you're looking more closely at some of those other C's to mitigate the risk that you aren't able to tap down and being able to perhaps use a piece of equipment, for example, to help them repay the loan if they're not able to. So it's all about risk management. This is the art form of risk management. To think about all of the potential areas of both strength and weakness within this credit risk profile. And then fundamentally get to a place, Sadiq, I appreciate that you headed right where I'm headed. Get to a fundamental place where you are comfortable with the level of risk you've decided to take, which is this process right here. So the nice thing is you don't have to take collateral. You don't really have to do anything. But what you do have to do at the end of the day is you have to be comfortable with the answer to that first question, and that is, am I comfortable with the level of risk I'm taking overall? And let me ask, from a credit risk perspective, can you all think about, we're talking about here, calibrating risk factors to match organizational risk tolerance and monitoring those indicators. Sounds kind of intense. It's not that intense, really. Can you all think about, in those sheets that you guys have filled out, for example, about your programs, what are some credit risk indicators that appear on those sheets? Can you guys think about credit risk indicators that you guys are already reporting on? Think about those sheets. What's some of the data? What are some of the data points on those sheets? Think about your loan portfolio. What are some of the things you're reporting on about your loan portfolio that would indicate the kind of risk you're taking from your credit decisions? Can we think of one of those statistics? It's got a percentage at the end of it. Sir? Exactly. Loan loss rate. You bet. So Sadiq, it goes back to your question. If you found a way to be able to, for example, eliminate collateral altogether, and then you set a loan loss rate that you're happy with, and make sure that you have then looked at your balance sheet as an organization to ensure you can afford that level of risk, meaning the amount of loss we're willing to take, we're okay with because we've got enough money in the bank to do it. You have just done an exercise in risk management. So if you find yourself with a market risk, for example, that is, we are working with a certain target market that has a certain set of conditions we want to respect about what they bring to the table. Then you get to look at the other three areas of risk: credit risk, operational risk, and liquidity risk, to say, how are we going to mitigate that? So, for example, another thread you could pull, if we're talking about making loans to individuals new to this country who do not yet have assets or credit, could be some threads we pull in our operational risk category. And that could be the way we staff, right? We're going to mitigate some of the credit risk with the way we manage our operational risk. So we're going to staff up in some new ways to stay closer to those borrowers, right? Oh, and you know what we're also going to do? We're going to go over to liquidity risk, and we're going to raise a little more money, so we've got a little bit more in loan losses, just in case. Or we're going to raise more money so we can change our pricing for those borrowers, because we want our pricing to look different for those folks. We want to reduce their interest rates, or we want to waive a fee. And we're going to make sure that we manage our risk so that we can do that. That, ladies and gentlemen, is the wonderful world of risk management. There's never a no in risk. There's just a what comes next. So there's never a no, we can't lend to that borrower simply because of this target market issue or that particular piece of credit risk. It is a, how could we do that? You may ultimately decide we cannot take on that level of risk right now because you know what? I can't raise enough money to lower that rate, or I can't staff with enough people right now to stay close enough to that person to give them an unsecured loan. But what you know once you've made that decision is that you worked very hard to try and get it there. And it gives you some goals to set for how you could serve that borrower in the future. And that, thank you for the question, because boy, you have fired me up. This, guys, is why I get so excited about risk management. Because risk management is nothing less than what we need to do very well in this work. It's what makes this so cool, is that we get to engage every day in what is the art form of community development finance. That when you pull way back, looks like this, that is continuous. When you do risk management well, it becomes a muscle that you need to help keep it stay toned. Whoa, did that come out right? Help it stay toned. Woo, end of the day. You know what I'm trying to say. Right? You want to keep it toned. Keep that risk muscle toned. And the way you do that is by staying in a constant process of risk management. So looking at the ways in which you manage risk within your organization, and we're going to talk in a moment about the way you can monitor that, and then stay in a continuous process of risk definition. So let me ask you this question. What are some ways that you all can think of within your programs right now to stay in a conversation about risk? Are there some obvious places or circumstances that you all can think of in the way you do business that are places where you could insert risk management conversations? What might be some easy and or program consistent ways to talk about risk management within the way you operate? Maybe meetings? You guys ever have team meetings? Yep.
So our loan department meets weekly, and we basically just review all the applications that came in during the week. And we look for trends and things like that. And the loan officers will typically bring up ideas and topics where they notice things with the clients that the underwriters don't necessarily see because we're not allowed to interact with them. So there's a lot of trust in them, and basically it's just touching base about new possible risks that come in that they noticed. And we just adjust our processes and policies based on that.
Jose, thank you. That is a wonderful example, and in fact, it's one on a slide that I've got at the very end as an example. What he talked about is what I used to call with my colleagues and team postmortems. Hey, it's a little bit of an intense thing to call it, but postmortem reviews. Now, often we were doing postmortem reviews not only right after a loan was closed, but we also would do them if we ever lost a loan. The whole team would get together and break that loan down by all of the credit risk factors. So it gave us the opportunity to pulse check, to say, are we still meeting the market that we want to meet? Are we satisfied with the way we delivered service to this client? And what did we miss? Because we missed something. If you lose a loan, you missed something. Even if something catastrophic happened to that person, I want you all to challenge yourselves to think about, what could I have done differently, even if it was in the service to that client as things were going badly? And if you'd like to learn more about that, come to my collection session tomorrow. But I really want to challenge you all around losses in particular, or even the first sign of delinquency is a real good opportunity to monitor your pulse on credit risk. Great example. It also gives the opportunity to keep your eye on something that is a part of operational risk. And I want to spend just a moment diving deeply on one area that I think is incredibly important for us as community lenders to keep our eyes on. Because the reality is, you all actually have big, huge bullseyes on your chests. Bad news. As community-based lenders, there are folks who would love to take your money and never come back, unfortunately. So, does somebody want to take a shot at reading this definition up here? This is old school. as I like to call it. Don Cressy's seminal work on fraud. So you want to read that out loud for me? Thank you.
Trusted persons become trust violators when they conceive of themselves as having a financial problem, which is non-shareable, are aware this problem can be secretly resolved by violation of the position of financial trust, and are able to apply to their own conduct in that situation verbalizations, which enable them to adjust their conceptions of themselves as trusted persons with their conceptions of themselves as users of the entrusted funds or property.
Yeah. So, I like pictures a lot better. So there you go. That is the visualization of what you've just heard. So Cressy did some seminal work around fraud. Ooh, yep, thanks. Good, yep. I was trying to have you guys really just sort of envision in your heads what it looked like. Are you there? Are you with me? Okay, no. The fraud triangle is what you've just heard, is Cressy's super wonky, clunky definition of the fraud triangle from his work, Other People's Money. And he's a big deal in the world of forensic accounting. What I love about this concept is this image right here. I mean, this is the visualization of what Cressy talks about, and it is the fraud triangle. And quite simply, it is the answer to 3 questions. And that is, does somebody have, obviously, the opportunity to defraud your organization? Will they? Should they? Can they? Do they have the opportunity? Are they willing to rationalize the decision? And is there some sort of pressure that they have in their lives that would lead them to do it? This is something I want you all to think about as an operational risk item, both internally to your organization as well as externally. Part of managing risk is thinking about and just being, it's what you said before, trust but verify. Just ensuring that you are always a guardian at the gate of your organization. Critically important component of risk management. So I want you guys to think about, as you are going through this credit risk assessment, what are some things that could listen for those things that could put folks in a situation where they would be interested in trying to take your money. Last concept, operational risk, a little bit more. Now, I know you guys had a session earlier today on turnover within your organizations, and I do just want to highlight a couple of high-level points here from an operational risk perspective. I want you guys to think about the kind of risk mitigants that you can put into place as program directors, as microfinance practitioners, in terms of who's on your bus and where they sit. And how are you helping them know where they sit on that bus? Are there things that you can do from a hiring, training, and support perspective to mitigate the risk that is your operational risk? And the folks from Forza mentioned it earlier. Because I do think that there are some things as campus microfinance institutions that you can do to help mitigate the operational risk of your team, including your team turnover issues. I think there are opportunities in the way you encourage people to come in. I'm going to use the word hire, but I realize in some cases it's just recruit. You know, they're students, and so they're not actually paid. But I encourage you to approach it that way. To be really deliberate and thoughtful about who you let into this really important program and work. And think of it as a hiring process. Once you bring them on board, I want you to think about how you're training these folks. What kind of messages are you giving them about what you do and how you do and why you do it? And then, finally, what kind of support are you providing one another in the work that you do? Because are there opportunities to continue to help the members of your organization learn and grow? Because we just talked about a lot of concepts today that I'm still learning and growing in. Managing liquidity risk, being aware of concentrations in portfolios. These are all things for which we can continue to grow in our knowledge and skill. That's the good news. And I think it's our responsibility as program managers or folks that are working on building campus programs to be mindful of that right out of the gate. All right, so finally, we've gone through a lot of topics on risk. So I just want to leave you with this and then some resources and then do a pulse check before we break for the day. And that is, you've got a couple of ways, there are many ways, not not just a couple, many ways that you can monitor risk. But here are just some obvious sources I have found of places where you can go to look at how your risk levels are performing. From a credit risk perspective, certainly you can look at aging reports. And you all know what I mean when I say aging reports. Okay, an aging report is simply looking at the performance of your loans. So even if you've got 2 loans right now, is everybody looking at how they're doing on a regular basis? Are those 2 loans on time? And do you know actually what day they're paying? Are they paying right on their pay date, or are they paying a few days early? We call that in the lending world an aging report, meaning what is the age of your receivables? Are they current? Are they past due? And if they are past due, how past due are they? That's something that you should be looking at as a team all the time. Certainly, the other thing you can be looking at things like credit scores. Once you've lent to them, you can be looking at credit scores to just get a sense of, again, how they're doing with their other credit. From a market perspective, lots of things you can be looking at. How's your outgoing activity? What do interest rates look like out there in the market? From an operational perspective, how's your team doing? Are they happy with what they're doing? And how do you know? And here's also the shout out to postmortem reviews. Are you having regular conversations in team meetings about how your loans are performing? And then finally, liquidity risk. Lots of fun financial reports you can look at. But fundamentally, does your organization have some form of a balance sheet, or do you want to try and put one together? Just so you get a sense, even if there's not a lot to say, of what that looks like, because it can get you into the habit of understanding how much resources you have. All right, so I know we've gone through a lot of concepts. So I just want to leave you with a few resources. You can get these resources. They're all available to you online, and I'm also happy to facilitate getting these resources to you. There's a lot of stuff out there on risk, guys, a whole lot of stuff on risk. And I suppose what I would tell you at the end of the day, when it comes to risk management, risk assessment is just all about common sense. That's why I love this particular rule. Leave you with a funny at the end of the day. Risk management really, truly is all about common sense. So I want you to remember the 4 areas of risk. I want you to remember that you guys are now artists who have at your disposal the colors of risk management available to you to paint those fabulous pictures of risk plus relationship to create impact. Let me check. What questions do folks have? Any quick questions that folks want to throw out with the last 4 minutes that we've got? Any major items? All right, you guys have been an awesome audience. Oh, wait, Dan, what's up? So the question was, is there any additional risk for Kiva Zip? And I'm going to make that even broader to say, what kind of risk do you enter into when you change payment arrangements? In this case, that it is a interest-free loan. Well, it's a fascinating question. I think from an underwriting perspective, this is now getting into more of a 5Cs conversation. There is an exposure to risk, I think, that's inherent when the person does not have to provide sort of the challenge and psychology of free. We all understand that people tend to devalue things that they don't pay something for. Behavioral psychology tells us that. But I don't think that's insurmountable, however. I do think it actually goes to Sadiq's example. Are there other ways in the relationship that you can mitigate what is the potential risk of devaluing something that is of value? So what are other ways you can create value in this particular circumstance in that relationship? I know Kiva's very focused on that, and I know that the Kiva partners are also focused on that. So in the risk management math, what I would always encourage you all to do is to figure out what is the other component of risk that is the flip side of what it is you're concerned about. So in this case, the sort of specific data point that you're curious about is the issue of no interest rate. Figure out what the larger symptom is that you're trying to address, and it is the perception of value. So what are ways across market, credit, liquidity, and operational risk that you can mitigate the issue of perceived value and increase the sense of value, and then make sure you put something into place to monitor it. Customer survey, very close monitoring of payments. Put some things into place that let you know if you're on track or not with that risk mitigating step. That's a critical piece, I have to tell you guys, is make sure that you put something into place that allows you to answer the question, how do you know? It's one of the most powerful questions you can ask yourselves in microfinance. We've got great relationships with our clients. How do you know? We're making a really deep impact in our community. Great. How do you know? We are mitigating our liquidity risk. Great. How do you know? I encourage you to think about the answer to that question and challenge each other with answers that are documentable and verifiable. And with that, I wish you guys a really, really good rest of your evening. Thank you for hanging in on risk management.